I'm Amanda Cassett, and you're watching Endgame. Today I spoke with Sean Neville, who's co-founder and board director at Circle, who also served for years as its CEO. Sean and I talk about Circle's recent IPO, stablecoin summer, competitors like Tether, and his new startup Catena that's building what he calls the first AI-native financial institution. Enjoy, and please hit subscribe. To get started, what is and isn't a stablecoin? If I have an Excel spreadsheet and a bunch of dollars or a bunch of T-bills, and I can record the movement of those dollars or T-bills from one account to another in my Excel spreadsheet, is that a stablecoin?
The difference with a stablecoin or digital dollars, digital euros, digital currencies, are that the audit trails are publicly transparent, so anyone can kind of track the movement without relying on a central owner of those monies because they exist on blockchains. And then they're backed by reserves of some sort, different reserves for different kinds of stable coins that sit in things like asset management accounts or bank accounts. So for something like a US dollar stable coin, it may be represented across a number of different ledgers. So public versions of that Excel spreadsheet in simple terms, but they're backed by real underlying dollars that sit in bank accounts managed by custodians. So that's generally the structure.
So one of the qualifying factors is that it be on a blockchain. Does just any old blockchain do? What do I get to call a blockchain here?
Yeah, so it's a good question. When we created USDC, there were some people who were interested in figuring out how can this work on Bitcoin? And at the time, the answer was fairly straightforward because Ethereum was the sort of programmable blockchain where you could do in-depth smart contracts that would allow all kinds of financial interactions, but would allow us to program things like digital dollars sitting on blockchains. And so that level of programmability on blockchains is really important in terms of, which blockchains would you trust for transferring your dollars. There's another set of calculus that goes into play, and some of those are related to scalability and security and those sorts of factors. But fundamentally, the chains need to have some degree of programmability in order to program these kinds of smart contracts.
So one of the most popular blockchains for stablecoin deployment is Tron. And I think some of Tron's detractors would say that it's pretty comparable to that Excel spreadsheet in many ways in terms of degree of centralization. Why can't I just launch a stablecoin on something that I call a blockchain, but that's still pretty centralized?
I think the issue here ultimately is trust. How do you go about attaining trust and then enforcing accountability when that trust is potentially broken? You look at things like centralization versus decentralization. One of the advantages of decentralization when it comes to trust is that you're not asked to trust a central record keeper to manage the underlying ledger or the data that flows in and out of that ledger. Instead of relying on a central company or group of individuals, you can rely on cryptography and you can rely on software. And so that's the fundamental promise. It comes with many challenges as well, because something that is broadly distributed cannot not necessarily be fully decentralized. You may have a small number of players that are operating technology that could be decentralized and more broadly distributed, but is actually still somewhat centralized. And so it's not really binary. It's not an either or. There's a little bit of a spectrum there. Ultimately, when it comes to things like money transfers, among other things, I think there are a group of us who are much more comfortable relying on things like modern cryptography than we are on the judgments of human beings.
Totally. And that was part of my motive coming into the space, is creating an alternate system that is governed by code, that has the same rules for everyone, that are public and visible, in contrast to opaque decision-making by groups of people subjectively. Not that that shouldn't exist, but that both systems should exist and people should be able to choose between them. So my question is, even when you're deploying a stablecoin on a more decentralized blockchain like Ethereum, are you actually using that blockchain's decentralization? Are you using those capabilities, or does the blockchain function in that case more like a transport layer for the US dollar? Obviously the plurality of stablecoins in the market that have been successful are issued by centralized companies. They're centralized stablecoins. So I guess I wonder, where are you actually using those decentralized capabilities of the blockchain? Where does that come into play?
Yeah, much of it does have to do with the infrastructure. When we look at specific use cases, like say cross-border transfers, the big issue there is that the infrastructure to cross borders is just broken and highly inefficient, even where it sort of works. Highly inefficient and expensive, slow. And so some of it is an infrastructure issue. If I want to pass dollars across borders around the world, then leveraging something like Ethereum, Solana, Base, these sorts of chains on which stables run is a very effective infrastructure solution. And then part of it is also visibility into how those dollars or other assets are programmed. And then the question becomes, once you have visibility into how they're programmed, the question becomes, well, who's doing the programming and how is that governed and managed, and different sorts, so governance questions. So it's both infrastructure, but it also, when you sort of look at which stables would you trust and on which chains would you trust them, it's a level of governance applied to how the code is created and updated. And in some cases, that governance may touch on traditional regulatory requirements. So things like, the Genius Act will specify a particular path for becoming a regulated stablecoin issuer that anyone who can follow the playbook can adhere to, but that will be part of the governance of how you are allowed to have a dollar stablecoin if you want a US dollar sort of stamp of approval stablecoin operating on these chains. So it's both infrastructure and governance. In some cases, the governance is tied to old school governance and laws and regulations in the jurisdictions in which those stables are meant to operate.
So let's talk about the infrastructure and the governance. So usually when a new technology comes out, maybe this is an oversimplification, but there'll be some kind of scientific breakthrough. And then a bunch of tech companies will try to adapt that breakthrough into a technology to try to harness some of its economic value by translating it into something that's useful to people that was previously impossible until that scientific breakthrough happened. I guess my question is this: what exactly is stablecoins replacing in terms of cross-border payments, in terms of the technologies that banks or that people were using before to send money to each other? What is it replacing, and why can that thing not just itself evolve and improve and start taking on those same characteristics?
Some of what it's replacing are these, stovepiped nodes on a network that are to varying degrees private or managed by commercial companies with very little visibility, not necessarily deliberately, but just through the evolution of those particular protocols on which they're based, which are things like text files holding money being transferred into secure locations via things like SFTP that someone then interprets. And sort of that is the old set of pipes, which is error prone. Only a certain number of or certain kinds of people were even allowed to participate on the network. And so when they undertook things like creating audit trails, record keeping, doing risk scoring, translating into other kinds of currencies, they charged fees for it. So it took time, it was error prone, and they charged fees for those things. A lot of that stuff can be completely automated when you have money moving across, public blockchains. And so the speed is increased, but also the programmability allows the errors to also potentially decrease and become safer. And then the fee structures changes dramatically. So there's still fees. It's not free to move money around the world, in exactly the same way it is to move data around the world, but it's pretty close to free on certain chains with these kinds of models. And so it's very difficult for the existing infrastructure, traditional infrastructure, to evolve into that, because it's a combination of old tech that needs to be completely replaced, but also deeply entrenched business models. So people who aren't necessarily that incentivized to even make the change in the first place.
So are we talking about things like Swift and ACH here?
Swift, ACH, credit card rails as well. Now, all of these things can connect to stablecoin rails as well, and there are initiatives for companies who are in those spaces to make that kind of transition. But something like e-commerce was designed to take something like the credit card rails and brick and mortar systems and just sort of bring it online. And what that ultimately evolved into was a set of stovepiped acquirers. But even aside from the raw network and how interchange works, there's sort of cottage industries of people who do things like risk scoring along the way. There's many parties involved in a card transaction, and that is kind of the network of how a payment happens in that particular model. And so it's both a tech issue of how all those things are connected to one another, and a business model issue that keeps those things entrenched.
What you're saying is that even though Swift or ACH could choose to settle faster and have fewer delays to its settlement, or could choose to lower its fees, or even could theoretically start using a blockchain. There's an innovator's dilemma issue with old technology, old companies, and kind of a natural, almost like mycelial process of new things coming and replacing them. Is that kind of right?
I think, that's right. There's many things to the innovator's dilemma. That's right. Also, it's difficult to make change happen, particularly when the necessary change is not just tech, but related to business models. It's much harder to change an entrenched business model, and when you get many different kinds of stakeholders participating and benefiting from that business model, it becomes even harder. And so, just the pace of change, but also the incentive to make the change in the first place, is different. So it's harder to stovepipe into an existing system like that rather than just replace portions of it. Keep the portions that work, underlying asset custody, for instance, and making sure there's a regulated, accountable, stakeholder, responsible for those things. But when it comes to things like this infrastructure of how money moves, we've had the technology, and now we are beginning to see the business model incentives to use these things in, say, non-crypto capital markets use cases, but for some of these global payment use cases, which is certainly why we founded, Circle in the first place, was to focus on those kinds of use cases. And now we're starting to see those become possible.
So, my question is this. In the early days of the internet, a lot of people thought that the system for making payments would be third party. It wouldn't be owned by any particular company that's selling their goods online, and that the identity system would be third party. You would have your identity on the internet, you'd have your payment info on the internet. That would be like your internet ID, internet payment, and then companies would plug into that. But that's not what happened. What ended up happening is, obviously each of the companies, the Googles, the Facebooks, they each wanted their own walled garden with their own payment info. They wanted to own that. They wanted to own the identity info. What's changed so that in this next generation of finance and the web, that we actually think this third party, this blockchain, is going to be where all this information lives, rather than the main participants wanting to own that and hold all that information? Do you see what I'm saying?
Yes, I mean, I think that there are still roles for people who are holding data responsibly, including individuals off chain. So not to say everything moves on chain, but the raw movement of funds moves on chain because of the efficiencies that can be realized, which is mostly down to trusting cryptography, and what that unlocks is the ability to remove certain middlemen or certain segments along the way that otherwise were sort of these approved gatekeepers that sat in the middle of those funds flows, when you don't really need someone sitting in front of those fund flows to make them safe, and make them compliant, and be assured that they're going to arrive on the other side to the destination you intend. Then the efficiencies become real. It just unlocks the ability to move money at a speed and a cost that we've just never seen before in any other kind of traditional infrastructure. And that was not the case, in the early days of the web. It wasn't there yet. I mean, we still don't have an identity layer for the internet, and there's some things that we expected to evolve that just to have not in the the version of the internet that we largely look at today with these big players. But I think the advent of stablecoins, and particularly the regulatory clarity that we're beginning to see around them now, has introduced other players into these new efficiencies that are unlocked with blockchains, money moving on blockchains, assets as well as stablecoins. And then the other thing that has happened is just the increasing, automation of all of this, even aside from blockchains, just the automation of businesses, and obviously the advent of AI, and what that means for global commerce. And so as businesses are embracing all of these changes, it makes things like stablecoins, the advantages, really the value props of things like stablecoins, much more obvious to new kinds of players who would not necessarily have been attracted to, say, the early days of necessarily the idealism of what some of us were building in those days, but are certainly attracted to the economic efficiencies that they offer now.
Let's circle back to the Genius Act. I saw that on your timeline with Jeremy. Excitement about finally getting some regulatory clarity. So maybe this is an oversimplification, but how I interpret it is making it really clear and obvious for how banks and other companies can issue their own stablecoins, making it kind of hard and lots of barriers for tech companies to issue stablecoins. How does this not make it just so easy and clear to launch a stablecoin that everybody starts doing it? Where does Circle fit into a world where every bank and their brother has a stablecoin, where anyone with a big USD or T-bill treasury is able to just pretty easily launch their own stablecoin? Why should
Well,
stablecoins come from these kind of third parties as opposed to issued by the same entity that is doing the banking?
yeah, I mean, I think one of the things about that we're excited with this legislation is that, and no legislation is perfect, but the thing that we're excited about is it is regulatory clarity about how to launch a U.S. dollar stablecoin.
Mhm.
And so when we say stable coins, we mostly mean US dollar-backed stable coins, which is obviously what this covers. I think this law, the kind of legislation we're looking at with the Genius Act, expected to escape the Senate, hopefully soon become actual law. It'll get out of the Senate, go to the House, and then, proceed along its merry path. But the clarity that it provides is to say, here's how if you want to issue a US dollar stablecoin, here's what you need to do by way of reserve backing. Here's how, at a certain level, it's sort of managed by states. Here's a level at which it becomes managed by the federal government. If you want to have a US dollar stablecoin and say it's a US dollar stablecoin, you must adhere to the United States laws and regulations. And it seems really obvious when you put it in those sorts of terms. But in the past, it has been more the case that it was just very unclear whether the US government would tolerate digital dollars moving on blockchains or not. Is it a security? Is it a mutual fund that we're talking about? Is it truly a dollar used for global trade? And if so, how is the US government, how do all these, how does the OCC get involved in governing it? And there was just no clarity at all. So when, parties were looking at just a risk reward analysis of embracing things like stablecoin flows, there seemed to be a whole lot of risk because there wasn't really any direction to speak of, and the reward was unclear. And so I think the thing we're excited about is that the risk is quantifiable now, and there's a way to be a licensed financial institution and participate, whether you're directly issuing or whether you're simply using these as digital dollars. And that's really positive. And so that's the piece we're excited about. The other part of the question is what happens if everyone issues their own stablecoin? My personal belief is that there should be more than one. I don't think that there will be thousands of them, but I think there should be the ability to issue US dollar stablecoins as long as they're interoperable with one another. So that if I have a digital dollar issued by Stripe, to pick a company, and there's a digital dollar issued by Circle as a business or as just as an individual consumer, I don't want those to be two totally different things. I want them to be seamlessly liquid between them because they're representing a dollar, which is how I would think about it. There should be more than one issuer as long as they're interoperable, and there should be, really clear regulatory guidelines about what that means for people who use them as well as people who do potentially issue them. And I also want to be sure that if there's suddenly a dramatic change in liquidity, that the reserves are managed properly.
Mhm.
And I'm not just taking anyone's word for that I can be sure that they're managed properly and that the federal government for US dollar stablecoins is holding the issuers accountable for managing those reserves properly. And so I think those are the reasons that we're enthused by this particular bill. As far as the proliferation of stablecoins goes, I think we will see a dramatic proliferation of use cases that takes us out of the crypto capital markets focused use case, which is where we've sort of been, into really interesting territory with all kinds of payments use cases. And we're already seeing that now, but I think we'll see it on a scale that would have been impossible without this kind of clarity.
So, what's the most interesting new use case that you have in mind when you say that?
So the ones that I think are most interesting to me, there are many, and I can talk about the e-commerce side and the use of machine money with machine intelligence. But even aside from that, the global flows of money that are most expensive and inefficient in a way that impact people's lives tend to be ones from, say, money moving from certain corridors in the world, from say certain global south to other global south corridors, or global north to global south corridors, where the fees that are taken are just so dramatic. It's just ripe for disruption. That's not even to say things like just remittance markets. These even bank to bank money movement is highly inefficient. And so those kinds of use cases are particularly interesting because of the outsized impact that they have on the economy. Those I think are particularly interesting in the near term.
So let's talk about the other stablecoins in the market and their strategy. So Tether has about 62% market share with USDT. And they've had this really different approach of going after the global south and emerging markets. I think you were CEO at Circle around the time that they were emerging and growing in parallel. I'd be curious to hear from you what the different strategy is as you see it between Circle and Tether and how you see that emerging.
So I don't have any insight into Tether's strategy or, exactly what they're pursuing. I would say generally at Circle, I guess you could say for better and for worse, we have always made an effort from the very beginning to go in the front door, so to speak, with regulators and spend a lot of the early days. Jeremy in particular spent a lot of personal time just educating regulators on what this was. When we were acquiring our money transmission licenses way back when, we had states that didn't even think we really needed a license at all. And so we really pushed on that. And in some cases, the reason I say for better and worse, I guess you could say we were pretty conservative on risk decisions, and maybe that caused us to miss some short-term opportunities. And the bet was always that it would pay off in the long run, and that particularly as we developed USDC, which we started building in 2017, and then subsequently launched with Coinbase. As we were building USDC, it is a US dollar stable coin. So the idea that we could not do it onshore, for instance, or not adhere to certain regulations just didn't match with what we thought our strategy needed to be over the long term. I think many others have a similar vision, but maybe to varying degrees or might have made different decisions along the way. Again, I have no idea how Tether, fits into that or what their strategy might be, but there are many others that have run different sorts of experiments, different kinds of backing, the algorithmic stablecoin movement and Libra, Diem, let's take a basket of currencies and, mark on that. And there's been many different experimental sort of approaches to it. So I can mostly just speak to what our strategy was, especially then, was to, even when it seemed like it was a conservative risk decision, to always go in the front door and try to work within the laws and regulations of the United States, in as much as we were trying to launch a US dollar stablecoin that would work everywhere.
So we're coming up on stablecoin summer, is what people are calling summer
Is that what it is?
2025. That's what people are saying it is. We obviously had the Circle IPO go really well, coming in at 8 billion and then kind of rocketing up to 22. And then we had Plasma with that 500 million token sale when they expected to raise 50 million. So there's just been tons of enthusiasm for these projects. And then I read that actually 1% of dollars have been tokenized as stablecoins at this point, which just seems like a extraordinary amount of dollars and really fascinating. I guess my question is, do you think that stablecoins will go down in history as crypto's killer product market fit use case? And if so, do you think that they fulfill the original vision of a Satoshi or a Vitalik in any way, or connect to it?
Yeah, that's a great question. I like the way you phrased it. So first of all, I've never been a fan of the word stablecoin. I don't think that we continue calling them stablecoins in a few years. I don't know it's just really money. I don't like digital dollars either, by the way. Digital attached to dollar, all dollars are kind of digital to me at this point.
Yeah,
So I don't know what the word
99%
is.
plus are digital, right? Like very little of it is physical.
That's right. Yeah. So right now, stablecoins is a useful term because I think it's cracked the mainstream. It's has achieved a little bit of escape velocity from some of, the other elements of crypto that more mainstream news might be quite skeptical about, and in some cases for good reason. So it's a useful term. I don't know if that's what we're calling these things, going forward, but I do think maybe somewhat of a controversial statement. My take is that stablecoins are the only thing in crypto that have found true product market fit so far, and that I don't consider assets or exchanges products. So I think it's the thing that has achieved true PMF. I think there will be other things, and there are many interesting experiments, and I've participated in a lot of those experiments. But from a product perspective, stablecoins are the one thing so far. Then I do think has achieved stands to achieve a portion of the original vision that many of us got excited about with crypto, which is to enable a new kind of payment system. It's a little bit, different than what Satoshi may have imagined with Bitcoin, I would suggest, but it is a means of transferring these assets on the public open internet, so to speak, with these blockchains. That's the use case that we care most about unlocking at Circle. I wouldn't say it's happened yet, though. I mean, the dominant use cases for things like USDC as well as the others are really so far in crypto capital markets, whether it's CeFi or DeFi, and even among the exchanges, there are only a handful that really move meaningful volume. And so the difficulty with stablecoins today, if you and I were going to go create a stablecoin, we'd have a lot of difficulty crossing the liquidity gap. And the liquidity is really the big moat right now in this crypto capital market use case. And there are only two US dollar stablecoins that have any meaningful liquidity. So I think as we start to unlock the more payment-oriented use cases and have a digital, cash payment system, that area of focus becomes a little bit, it doesn't go away, it's still important, but it becomes less important globally to many businesses that are transacting payments. So I don't know if that fully answers the question, but that's sort of how I think about it.
Makes sense. I just have the words that Satoshi inscribed on the Bitcoin Genesis block, Chancellor on brink of second bailout, ringing in my ears as I watch stablecoins become our most product market fit use case in the crypto arena. So amused that you observed that as well. But yes, agree about the transparency goal and the permissionlessness goal. Let's move to Catena. You just raised 18 million seed from A16Z crypto. Congrats again for
Thanks.
what you're calling an AI native financial institution. What is that?
We have spent the last, as a team, 18, 19 months building AI orchestrations and workflows. And emerging from that, we developed very firm conviction that the web itself is entering what we think of as an AI native phase. There's a level beyond just leveraging things like chatbots or tools for code completion, but a new level where AIs will be economic actors. And we think that this ultimately touches every domain, but not all at the same time. But we think it will touch every domain, and that ultimately AI actors are likely to be the only actors that execute financial transactions. Ultimately, AI actors will be the only ones we trust to manage our money, because it'll be the safest way to manage money, and it'll be the only competitive way to earn a return on our assets. And we're certainly not there yet in terms of where we are with LLM intelligence and orchestrations and so on. But we do have conviction that that's where we're going. And if you believe that, then it becomes much more obvious that stovepiping an e-commerce set of APIs onto LLM orchestrations is pretty flawed and not reliable, and not the way that these AIs will be executing transactions in the future. Our belief is that in order to have a truly AI native way of managing assets, pay-ins, FX, treasury management, payouts to humans as well as other AIs, that we ought to think about building a new kind of financial institution that is itself built with AI from the ground up, with the assumption that ultimately the customers of this financial institution will be other AIs. So that's the framing. We got very excited about this idea, and talked a bit about this vision, where we think we are in terms of the roadmap of realizing certain interesting use cases. But as you said, we found great partners in A16Z crypto, and Chris Dixon and his team have been phenomenal. And now where we are is we release some open source components that are really just building blocks that we use for agentic identity. How do you identify these things? Are you sure you're talking to the AI you think you are? How do you enforce policies around them? And then how do you execute payments between them? So we released some open source building blocks, but we have not released the product yet. And so we're head down right now building the product for an imminent release.
Excited about that. So for me, with all these technologies, I can really imagine where they're going. And I've been invited a lot by entrepreneurs, by media, storytelling to imagine. And so I get in a Waymo, and it looks like it's a self-driving car, but then I learn it's actually teleopt and proper, true AI self-driving is 10 years away. And I get in the Tesla, and the self-driving is pretty bumpy and jerky and scares the heck out of me, honestly. And I just want to disable it. And then with the AI agents, I can absolutely imagine a world where everything that I'm handling right now, transaction-wise, is handled by an AI. And I can see how it would be easier to have AIs do things for me rather than do them myself. And yet, I'm the one still doing all of my transactions, kind of like how I'm gripping that wheel when I'm doing some kind of self-driving. It was purportedly self-driving, or how a lot of the self-driving things are actually kind of teleopt, right? My question is, what do you think the first thing is that I'm going to do with an AI financially? Because right now, I basically only use AI for research, for education. I don't really use AI agents for doing anything on chain. There's that banker bot that I've seen on Twitter. You can spin up an AI to buy you a certain token, and you can just tweet at banker bot and it spins up a
Yeah.
wallet and everything. But frankly, it's so easy to spin up a wallet and buy a token because everyone wants you to do that anyway, that's kind of easy to do. And so I've never been tempted to use it. So my question is, this gap between the vision and the present, what's the first thing we do that surmounts it? What's my first action going to be that's really palpable using AI on chain?
Yeah, there's a lot there. So I will answer that question first, but I also want to talk about where I think we really are, what's missing, and why aren't we at a place where you could use AI the way that you want to use them. I mean, well, to answer the question first, I think the use cases that we see emerging right now are more on the, I guess you could say, B2B side than on something that a consumer would necessarily see. And those are real. They're not in every domain, but they're in many domains. And so we can talk about what those look like. But there's still
Mhm.
some fundamental problems with this. And it's to the, in your examples, it is, I think, a shared experience by many people that using LLMs, so using LLM-driven systems is, that's what we mean when we talk about AI. It's almost like it has become good at some of the data synthesis and the creative
Mhm.
output, but it's made us be the ones to execute all the actual tools to do the things because it
Right.
can't really do anything yet, at least not reliably yet. And it's just sort of where we are in the state of things. And this gets to like no one can agree on what the heck an agent actually is. Everyone has a slightly different, slightly different definition, but loosely the way we think about it is that there's intelligence. So one or more LLMs doing, uh, LLM non-deterministic computing. But importantly, it can do things in the real world. So today, the way to do that is a particular mechanism of connecting tools. And these different LLMs have something called function calling so that you can hook up an API to them. MCP servers have kind of made this a little bit simpler and more reliable. But it's just this notion that in addition to the intelligence, it can actually do things in the real world. And that those things that it can do can be tuned so that they're reliable and you don't have to wonder whether it's really going to do them correctly or not. But there's some sort of measurable way to improve reliability of them doing real things in the real world. And then the other two elements of you think of with an agent is it's got to have some understanding of memory or data context.
Mhm.
These things tend to be sort of short memory oriented. So the concept of midterm memory and long-term memory can be a fuzzy thing, but it needs to have some concept of memory. And then lastly, it needs to be able to do some degree of auto planning so it can understand when it may need to at least retry something again before it shares the outcome with you or tell another LLM to do something a little bit differently. And so, to us, if you have the intelligence, which is what people are focused on now, but then reliable tools execution with memory and some auto planning, and that is fundamentally what an agent is. And when we talk about, more complicated interactions, you don't really you don't really succeed with an interaction, be it financial or otherwise, with only one agent. You need
Mhm.
agents working together in order to accomplish those things. And so you end up with a composition of these things. And the composition is what we're really focused on when we're talking about some of the vision, because you need that composition of reliable agents. But realistically, where we are now is we're still working out how to make the tools execution really reliable in a particular use case. And there's just some fundamental things missing around, how do we don't have standards for even finding and identifying agents accurately. There's no real DNS for agents. Like DNS runs websites. If I enter my browser amazon.com, I'll be routed correctly. There's no such thing for agents right now. There's no real SSL equivalent for agents. So we couldn't build amazon.com without HTTPS and SSL, but it doesn't
Mhm.
really exist for agent to agent communication and identification. If I'm interacting with Amazon through its agent, how can I be really sure that it's actually Amazon? Sort of fall back on HTTPS now, which is ultimately not sufficient. So there are many of these fundamentals that need to be addressed first. The good news is nothing in my experience, I've been building software a long time, and nothing in my experience has moved as quickly as the AI space has. And it's exponential because the changes are AI assisted. So, I'm very confident that we'll be able to address these. This is the worst it will be, is right now. It's only going to
Mhm.
improve and get better. But coming around to your original question, I do think some of the consumer use cases will be among the last that are really impacted by some of these
Interesting.
agentic, workflows, particularly on the financial side. And there's a lot of reasons for that. Some of them have nothing to do with the rails, transactions per se. Some of them have to do with, things like in e-commerce, just user experience. What does it look like to shop with an agent I think most of the experiments now have been, well, you use a chat bot, which just does not seem like the final solution. There's certain kind of purchases that are just annoying that I don't want to have to make, and I would love to offload that to. I had to deal with buying train tickets. I don't want to do that again. I would rather some agent handle that. But I like browsing on Amazon sometimes, or I don't. It's a slightly different sort of shopping experience. So there's a UX consumer oriented, sort of product thing there that is a level higher than the infrastructure of both AI and the financial rails. And those are tough to crack. We're not trying to solve those ourselves. Many others are. In the B2B space, there are some cases where we're seeing AI to human payouts and human to AI pay-ins, but not yet at scale AI to AI payments. So that's just our observation from where we are now. But the AI to human payouts are super interesting. It's prime, usage for virtual accounts or stable coins where an AI needs to pay in machine money and the human on the other end wants dollars. Doesn't really care if it's USDC or USD XYZ or whatever it is. It just wants to be, reliable stable coin. The mechanism for an AI to pay out to a human directly into, say, a digital wallet is very efficient, very fast, and can be very affordable. So those use cases are the ones that sort of emerged early. There's also, in terms of early use cases, things like licensing of content. So not necessarily just for pre-training, but even potentially at inference time. So if an AI is pulling in content from creators, licensing that content, on the fly potentially, where the content creator can say something like, if owners or certifiers of these kinds of AIs say, I trust Anthropic, but I don't want to let, some other random LLM starts scraping my content, I'll trust Anthropic to access it, but I want to charge this amount for this kind of content. Many
But aren't they
experiments there.
currently accessing it kind of for free?
Many are, yeah. Many are, or they're being outright blocked. So it's binary. They're either getting it for free or they're not getting it at all. And so there are many experiments with how do you get it ethically? How do you pay for it? And how do you license it potentially with terms? So the license might expire. How do I do all? There are companies that are working on that space. And those are fundamentally AI, paying in, or humans paying in some cases, but many cases AI paying in to a system that ultimately pays out to a creator.
Yeah, I just wonder
So
about the cost of AI because right now the costs are so heavily subsidized by venture capital. And I know as a heavy O3 user that I am costing them way more than I'm paying them. And I wonder, first of all, as we get more advanced models that have more computational cost, whether consumers are going to continue getting the same level of service they're becoming accustomed to at these prices, or whether the prices are going to have to go up at some point. And I
yeah.
wonder if we're licensing every piece of content that goes into these things, whether they're going to be affordable to people.
It's a reasonable question. I mean, a few thoughts on that. One is that in the use cases that we've been working on, people are not particularly price sensitive yet. Now, whether that's
Because
sustainable
it's
is
very
another matter.
B2B.
Very B2B, but even in some of the say more research oriented consumer cases, or using AI tools to augment your own productivity and in whatever your profession may be. The big issue is really quality, trust, reliability. Those are the big things. So we did have a thesis at one time, which was people would be somewhat price sensitive, and that the more capable models are more expensive than the faster, more lightweight models. And so would it make sense to do some sort of intelligent routing so you could make it more economically efficient to use LLMs based on the task at hand? And mostly we found that people didn't care about price because the quality was such a huge issue that is what they cared about. And so that's just one data point. There is a bigger thing happening where the business model of the web is evolving, and it does feel more like there's at least a three-party flywheel that is emerging, which is these intelligence providers, whether they're hosting agents or they're hosting LLM foundational models or whatever it is, they need data of all kinds at different time, not just for pre-training, but they need data constantly. If they're an agent that analyzes an MRI scan, and they would like their results to be reviewed by medical professionals, then they need to find those professionals and pay them, for the data that they're providing. So not even just for pre-training, but even for sort of tuning and eval optimization. The intelligence providers need data. The fundamental providers of the data are humans, even if they're not providing all the data. Some of the data is synthesized by other AIs. Right. The humans are curating the data.
And also synthetic data generated by
It can be
AI.
synthetic data. Yeah. But the humans are still the ones who have the role of curating that data and making sure it's good. The outputs are good based on the data that is being assimilated, and then the humans themselves pay for, we as humans, human businesses as well as individuals, pay for intelligence to the degree that it increases our own productivity. So you end up with a kind of a three-party flywheel between data providers and curators who pay humans, humans who pay for intelligence, and intelligence who pays for data. It's a simplified flywheel, but it's quite different than the advertising-oriented model that we have on the web today. How that plays out in different domains remains to be seen. But what we were talking about with content licensing is one sort of obvious case that people are experimenting with.
So I want to be respectful of your time, but I also have one last question, which will be our only speculative future-looking question that I ask anybody that comes on here and talks about AI, which is to try to plot yourself along the spectrum from AI doomer to AI abundance utopian. Because that flywheel that you were outlining is really interesting, but I can also see how potentially, if more value is being kind of siphoned from humans, turned into AI, and then fed back to them at a higher cost than they can afford, I can see how that cycle could eventually, not be what humans want, or the opposite, where perhaps that cycle itself increases productivity, increases purchasing power, so much that we get that kind of abundance world, like what, I don't know, the CEO of Anthropic has laid out. So where would you place yourself along that spectrum?
So I see the perspective of, I think this was I think it's maybe a Reid Hoffman thing, but the sort of doomers, gloomers, zoomers, and bloomers, I think is the thing that he has. I can see the perspective of each to varying degrees, particularly at different times. I think it's really an exciting thing for certain, kinds of professionals, but it's also very disruptive. And so the flip from, say, software engineers, it's very difficult now to hire a junior software engineer, because if you can get a mid to senior level software engineer who's very, very good at using AI, they effectively bring 10 junior engineers with them because of the pipeline that they're able to leverage. Well, how do you train people to become so good at that? As they're junior in their careers, how do you train them to be at that level? There's a time gap there where it's very disruptive to the profession, but ultimately will mean that we're capable of doing, it won't eliminate the profession. It'll mean we're capable of doing many more interesting things, transform the profession. And I think that'll happen in many areas. So at different times I might be more of a doomer or more of a zoomer or bloomer. The difference, as I understand it, are the doomers are the Terminator is going to come. AGI is going to destroy us all. I think the gloomers are more like, you're giving it too much credit. It's not that good. ChatGPT can't even give me a reliable recipe. So just everything is, the gloomers is kind of the worst category. And then the zoomers are full speed ahead, of course. This is going to transform everything in the only positive ways. The bloomers are more like very optimistic, but we're seeding different experiments and being careful about what we cut and how we curate it. And we will ultimately grow something that's very beneficial. And so obviously, phrasing it like that, you can imagine I think of myself as a bloomer.
I think that's a great place to wrap up. Thanks so much, Sean.
Thank you, Amanda.
May we bloom. Thank you for listening to this episode of Endgame. Please follow me on X, Amanda Cassett, 2 S's, 2 T's. Follow the company I founded, Serotonin HQ, and listen wherever you get your podcasts: YouTube, Spotify, Apple Podcasts, the works.